Good afternoon. Good afternoon and welcome to all the participants who have joined this channel-based counseling program. I, Dr. Puspalata Mahapatra, before going to discuss the topic like risks and return, and under the which is under the block 1 of the Introduction to Financial Management. Before going to the topic, let me talk about the introductory portion of the risks and return. As all of you know that finance is the lifeblood of the every business organization, irrespective its size, its nature. So also all the business firms, business organizations, and the individuals, they prefer to go for investing their funds in many of the alternative investment channels. Many of the alternative investment areas they want to invest their money. So then why they're interested to go for that investment? Why they prefer to go for that investment? So that's why to discuss the return, the risks, and the trade-off in between the risks and the return, I have designed the topic and the outline of my presentation or my class is restricted and limited to first one. It starts with the concept of risks and return analysis and the trade-off in between the risks and return. Then it is followed by different types of investment risks, which is coming under the systematic and non-systematic risks. Then my topic is also going to focus on the areas like the financial risks and the influential factors that affect the risks in the investment of the equity shares. And finally, it will be winded up with the calculation of the total return. So every individual person or the business firm, they show their interest for going for investment of their accumulated funds due to many reasons. The reasons may be to build the wealth, to stay ahead of the inflation, to save the tax, to meet their financial goals, and to take the risk tolerance level on account. So first one, to build the wealth. It is the guiding objective why most of the people, the individual person, the farm business funds, they prefer to go for investing their accumulated funds or their savings with them. First one is to build the wealth. Everyone, irrespective of the individual person and the business firm, they want to increase their fund into certain level, which is known as the wealth. So to build some wealth to meet the future needs, generally the individual persons as well the corporate sector, the business firm, they want to go for investment. Then to stay ahead of inflation. Everybody experience the inflation. Inflation when each year due to the increased level of inflation, the value of money is going down and down and the money value is decreasing day by day. So to fulfill that gap, to go beyond the inflation level, everyone needs to go for the investment of their accumulated savings. Then some purpose is that tax purpose. Some of the people to get exemption under the tax, they want to go for investment. There are some specific investments are there, like investment in insurance, like investments in building the house. Some sort of exemptions are granted by the income tax authority. So to avail that income tax and to avail the tax, again to meet some of the financial goals. Many of the persons, they have built their financial goals and they have set their goals and objectives. So to attain that financial goals and objectives, many of the person and the individual person, including the business firm, they prefer to go for that investment. Then if this is so, then what we generally understand by that investment? And by saying the investment, what are the things coming forward, which is related, which is attached with the investment? So investment, an investor, when going for investment, generally prefers liquidity for his investment, safety for his funds, good return, and with minimum risk and maximum return. So when anyone will go for investment, so that time he will be termed as an investor. As an investor, he expects and prefers the liquidity. Liquidity means the availability of cash to do any transaction. So if any investor wants to invest its money, then some sort of liquidity is required for him. Liquidity means, so as and when it will be required by the investors, he can get back that one and he can utilize for doing that purpose. And safety of his funds. When I'm talking about the investment is attached and related with so many words like liquidity, safety, good return, minimum risk, and maximum profit and maximum return. So all the time the investor tries to attain all these things. So in either in the form of liquidity or in the form of safety or in the form of good return and minimum of risk. So that safety of funds and good return with minimum risk or minimization of risk and maximization of return is the primary goal or objective of all the investors, irrespective the type of investors. Either the investor is the individual investor, the foreign institutional investors, or maybe the corporate sector or the financial institution, they also become the investors. So all the times, whoever may be the investors, but they need liquidity, they need safety, they need good return with minimum risk and maximization of return. But above all, another primary objective is related with the return, and that primary objective of deriving a return either in the form of yield or in the form of capital appreciation. So the primary objective of investor is to get either in the form of yield, yield means the dividend, or in the form of capital appreciation. Capital appreciation means when the capital will increase year after year, month after month, then that can be termed as the capital appreciation. And we can calculate the capital appreciation sales price minus the purchase price. If the sales price is much more than the purchase price, if the sales price is greater than the purchase price, then we can say capital appreciation has been taking place. So when we are investing our money, we are investing our surplus income, that time as an investor, obviously I will expect some yield as well as some capital appreciation. And then what we understand by that term risk. Risk is inherent of any investment. Investment means some sort of risk is there. Almost in all the alternative investment opportunity, they are attached with some sort of risk. The risks may vary on the basis of the issuer, on the basis of the person who has issued that risk instrument, who has issued that instrument, and where the persons, the investor, they are investing their money. So risk is inherent to any form of investment. The risks may relate to what we understand by the risks. The risks may relate to loss of capital, delay in the repayment of capital, non-payment of interest, or variability of returns. When we are not getting back our capital, our principal amount, then that is the total loss of capital. That is some sort of risk is there. When we are investing our money, our surplus income, then the chance is there the total capital may not be returned by the person to the investors. That time it is leads to the loss of capital. When some delay of payment, sometimes the payment including the interest, the capital may be delayed, may be deferred. So sometimes non-payment of interest also. So that is known as the risk with respect to an investment which is done by the investors. Again, where the investment, as you know that from the company's point of view, investment is just like an asset or item acquired with the goal of generating income or appreciation. Income here means the yield. Yield here means the dividend. When I am talking about the investment from the company's point of view, the investment is just like an asset, and that asset, that investment will be shown in the asset side of the balance sheet. In the debit side of the balance sheet, the investment will be shown as an asset. And why the investment has been done by the company? The investment has been done by the company or the business firm of organization with the goal of generating income and appreciation. Income. So distinct. So whenever I'm talking about the investment, so that investment can be done either with the shares or with the debentures or with the bond or with the purchasing the property or the cash equivalents like the properties like the raw materials we can invest our money. So investment, again, investment as an asset. After knowing the investment and asset, again we can say investment is the utilization of resources in order to increase the income or production output in the future. We are also doing some investment with the objective, with an intention, how to increase the income, how to increase the production, so production output in the future. When we are investing our money by purchasing the raw material, here what our objective is, how to increase the output. When the output will be increased, that will be shown in the market, more revenue will be generated, that will leads to the more profit and revenue generation will be possible. So in which, so here the investment is the utilization of resources in order to increase the income, in order to increase the profit, in order to increase the revenue, and the investment is done in the production to increase the output which can be sold in the market in the future time. So investment, when someone is investing their money or their fund, so some basic objective is to be fulfilled. The basic objective is how to maximize the return or the income. How to maximize the income or return means how to increase the return or the income by investing our surplus amount either in the fixed assets or in the some other assets with which will leads to the increase in the output. Then how to minimize the risks, how to go for the capital gain, and how to hedge against the inflation. When inflation is increasing with the span of time, with year after year, so that time, if we will not go for the investment, they may not able to face the inflationary situation in the future. So because if we have some income, we have some surplus amount savings, if we will not go for investment, then that amount after 2 years or 3 years will not able to face the inflationary situation. So to overcome the inflationary situation effect, generally the individual person, the investors, to go for the investment. So by saying the investment, many things are coming forward, and some of the words, terminologies are attached with the investment. These are a return, risk, safety, and liquidity. So these are the common terms which are related, which are attached with the investment. So let us start with the what is risk, then what is return, then what is liquidity and safety. These are the common words. These are the common terminologies which are related, which are attached with the investment. First one is the risk. Risk I have already talked about. What is risk? Risk means the probability that is expected in the form of return from the security or investment will not materialize. What is the probability that the expected return from the investment or the security will not materialize is known as the risk. So हम जब सोचते हैं, हम जो expect कर रहे हैं from the investment, that may not be able to realize that. We may not able to get that. Then that is risk. So risk is the inherent of every investment. Means investment means risk is there. So risks may be loss of capital, then the loss of delay in the payment, non-payment of interest, then variability in the return. These are the these are the results of the risks. If the risks will be there, then whatever expectation, return expectation we have, we may not able to get that. That may not be materialized. So investment decision would be based on the anticipated return every time. So if that anticipated return will not materialize, then we can say that that happened due to the presence of risks. So the first terminology related to the investment is risk. Second one is the return. What you understand by the return? When risk is there and we are expecting something from our investment, that is nothing but the return. Return is the total gain or a loss achieved from an investment over expected given period of time. The total gain, if you are getting the total gain from an investment over a period of time, means 1 year, maybe 5 years. So whatever total gain we are getting is known as the return. If the reverse will happen, not getting the gain, we are suffering from loss, that loss also is the return from our investment. So next to the return risk, the next terminology is known as the safety. The safety of an investment is always desired by the investor. Safety hona chahiye. The safety of an investment implies the certainty of return of capital without loss of money or a time which every investor desires. Without loss of money, without loss of much more time, if we are getting our return, the expected return, then we can say that the investment in that area, in that place, is much more safety. That alternative, the investment in that alternative is much more safety. So every investor expects to get back his capital on a maturity without loss and without delays, known as safety. If I am investing my money in the mutual fund, I'm talking about the different investable channels, different investable alternatives where the investment can be done. Investment can be done either by purchasing the property or by purchasing the units of the mutual fund or by investing in the stock market or by investing in the debt or in the bond market. So these are the available alternatives where investment can be done. So when an investor investing its money, every investor expects to get back his capital on maturity without loss or without delay. That is safety. So every investment, it is related, is attached with the four things. First one is safety, liquidity, then safety, liquidity, risks and return. So after risk, return, safety, the last one is the liquidity. Liquidity, what we understand by the liquidity? An investment which is easily sellable, which is easily marketable, without loss of money or without loss of time, is said that it has possessed the liquidity. If any investment which is easily sellable, it can be sold in the market very easily, or which is marketable without any loss, without the loss of money and without the loss of time, we can say that it possesses the liquidity. So if we invest our shares in the market, then it is more liquid in nature because it has a primary market, stock market. If we purchase our shares, then that can be tradable in the stock market, in the secondary market, Again, by selling our shares, we can get back the investment amount either with profit or with the some sort of loss. So that liquidity is there. Some investments, when we are talking about the liquidity of investment, some investments are there like company deposits, bank deposits, post office deposits, NSE are not marketable. But some investment instruments like equity share, preference share, debentures are marketable because for their marketing, one secondary market is there where these instruments, financial instruments can be traded. So all the financial instruments where the investment can be done either may be marketable, may be non-marketable. Marketable financial instruments are there which can be traded in the stock market or in the secondary market. Whereas some deposits, bank deposits, post office deposits, NSC, NSS, that certificates cannot be traded. That's why they are non-marketable investment opportunities. So equity shares which are listed on the stock exchanges are easily marketable through the stock exchange. So after knowing the risks, return, safety and liquidity, let us go for what is risks and how risks and return are related with each other. What is risks? As we know that risks are various types. Risks may be financial risks, may be business risks, may be foreign exchange risks, may be some other types of risks which I am going to talk about. So, but all the times risks and returns are related with each other. So that we can say risks and return go hand in hand, and higher returns means greater risks, while lower return means greater safety. Risks and return trade-off only indicates that higher risk investments have the possibility of higher returns. So as we know that risks and return go hand in hand. Where the risk is there, the return is there. High risk is there, high return. On the vice versa, low risk is there, low returns. So to explain the risk and return, I would like to give an example. If I'll give two examples, and where less risk, less return, and high risk, high return is there. If one deposits all his money in a saving bank account, I'm talking about saving bank account, he will earn low return. If some investor investing rupees 1 lakh in one saving bank account, he will earn maximum, which is saving account, 4 to 5% rate of interest. And the interest rate paid by the bank, but all his money will be insured up to rupees 1 lakh. The insurance company is there, ECGC company is there. So by that, the amount will be insured. If something will happen, all the amount will be payable by that insurance company to the investors. But at the same time, the investor will invest all these 1 lakh rupees in equities in the stock market. The chance is there he may get higher rate of return. The chance is there he may face the risk of losing the major part of his capital along with the chance to get much higher return than compared to the saving deposits in the bank. The chance is there if he has invested his money in the equity market, which are traded in the stock market. If he has invested, then chance is there he can lose all his amount or his major part of his capital. On the other hand, the chance is there it can be increased. The capital appreciation may be there. It can be increased from 1 lakh to 1,25,000, 1,20,000 like that. So if that investment will compare with the saving deposit in a bank, obviously in the saving deposit in a bank, less risk is there, less return is there. But when you are investing in an equity, so more risk is there, more return is there. Take another example. If an investor chooses to concentrate 90% of their portfolio in stocks and 10% on bonds, so which may realize higher returns as compared to an investor who only holds 40% of their portfolio in stocks and 60% in bonds. If 1 lakh rupees will be divided, 90% means 90,000 will be invested in a portfolio where 90% is the stock, 10% is the bond, then it will realize higher returns than the investor who holds 40% of their portfolio in stocks and 60% in bonds. When you are investing in bonds, fixed rate of return in the form of interest will get, and 40% is only the risk side amount. So that portfolio is obviously less risk as comparison to the portfolio where 90% is the stock or equity and 10% is the bond. So obviously these two examples explains where more risk is there, more return is there, where less is risk is there, low return is there also. So investors to get out of risks, diversify their portfolio. All the times the investors tries to diversify their portfolio among equity, among the equity, bond and debenture. That's why they try to choose an optimal mix of different investment options through which they can reduce the risk and they can amplify the return. They can increase their return. So simultaneously they can reduce the risk and they can amplify the returns. That's why diversification is one of the method through which we can decrease the risk amount and we can amplify our returns. So that's why the risk return trade-off concept is there. So every individual investors, before investing their money, they tries to do the analysis, risk return analysis. And while going for risk return analysis, the investor tries to implement the risk return trade-off. So what we understand by the risk return trade-off? Risk return trade-off is the balance between the desire for the lowest possible risk and the highest possible return. So the risk return trade-off is different for the different investors. Higher risk associated with the greater probability of higher return and vice versa. The risk return trade-off, when an investor is going to risk return trade-off, he is trying to analyze how much risk he can take and how much profit he can take against that risk. So risk and return analysis based on underlying the principle of risk return trade-off. When we are going as an investor, we are going for a risk return analysis. The underlying principle is that risk return trade-off. So that trade-off means, as we know that risk return go hand in hand, higher return means greater risk with lower returns promise greater safety. So that's why before evaluating the risk return, every investors use many methods to analyze and evaluate the market, the industry, and the company to find the risk return trade-off. So risk return is just a balance. It's just a balance between the desire for the lowest possible risk and the highest possible return. All the individual investors, they tries to get that point where higher possible return will be there, where lowest possible risk will be there. So when they are making a balance in between the lowest possible risk and highest possible return, they tries to develop that risk return trade-off. This risk return trade-off is different for different people on the basis of risk tolerance, on the basis of time horizon for investing, on the basis of objectives of risk, capacity, etc. So that is different from people to person, and individual person to individual person, and every individual person on the basis of their risk tolerance capacity, on the basis of the time horizon of the investment, the on the basis of the objective of the future goals, the risk return trade-off differs from person to person. Here I am showing through the graph, I am trying to show the risk return relationship. Here, in the past graph, risk in the left hand side and return in the right hand side. The risk, when the risk is increasing, as well as the return is increasing. When the risk is decreasing, the return is also decreasing. So the underlying principle behind the risk return relationship, that high the risk investments will give the better returns. So though there are many options of investments are there, either the investment option is in the bank deposit or public sector bonds, corporate bonds, mutual funds, equity, venture funds. These are the alternate sources of investment. So if we analyze one by one, the bank deposit is the most safest one. Lowest risk is there. That's why bank is offering lower rate of return. Next to the bank deposits, the next one, public sector bonds, when issued by the government. Public sector bonds, when issued by the government. Bonds may be issued by the public sector, by the private sector. When it is issued by the public sector, like the government, central government or state government, then that type, it offers fixed rate of return, and somehow it is lowest risk is there as compared to the corporate bonds. Corporate bonds are the private sector bonds. They also give the fixed rate of return, but if the comparison will be made in between the public sector bonds and the private sector bonds, obviously public sector bonds are more safest as comparison to the private sector bonds. Next one is the mutual fund. If we make a comparison in between the mutual fund and equity, investment in the equity share, obviously mutual funds, the low risk as comparison to the equity shares. So in mutual fund, the risks will be diversified. So when there will be a loss in one unit, that will be compensated by the other units of the mutual fund. So that's why mutual fund, some sort of less risk is there lies with the mutual fund as comparison to the equity market. As equity shares are traded in the stock market, so the heavy chance is there to lose the major portion of the invested capital. Sometimes the chance is there we can get higher rate of return also. But the highest risk investment opportunity is the venture funds. If we invest, the venture capitalists, when they're investing their funds in the venture funds, that time they are bearing the highest risk, where the risks may be increased, they can get much more return, but at the same time they have to face the highest level of risk also. So on the basis of the risk return relationship, the bank deposit possess the lowest risk, whereas the venture funds possess the highest risk. So as the bank deposits possess the lowest risk, that's why the return of the bank deposits is also lower as comparison to the other investable options. So after knowing the risk return, their relationship, and the risk return analysis and the risk return trade-off, now let us know what are the different types of risks that exist. What are the different types of risks that exist? The risks may be different types of risks exist. The risks may be business risks. The risks may be financial risks. The risks may be non-business risks. So what we understand by the business risks. Business risks are taken by the business enterprise to maximize shareholders' value and profit. So why the business will take the risk? The risk taken by the business is known as the business risk, and the why the business takes the risk. Business take the risk known as the business risk only with an objective how to maximize the shareholders' value as well as how to maximize the profit. How the shareholders' value will be maximized? The shareholders' value will be maximized if the capital appreciation will be there. Capital appreciation means if the capital appreciation can be, the capital appreciation can be calculated, the number of shares the investors hold multiplied by the share price. If that amount is much more than what they have invested for purchasing the share, then we can say the shareholders' value has been maximized through the capital appreciation. That also profit should be maximized. The profits, the company can maximize the profit year after year. Either two methods are there, either by increasing the sales or by lowering the cost of production. With the same level of scarce resources, if the company increasing the sale, then the profit can be increased and the profit maximization can take place. If remaining same, if keeping the output, sale output remaining the same, if the cost of production will come down, will lower, then automatically that will lead to the profit, increase in the profit and known as the profit maximization. So companies undertake high cost risks in marketing to launch a new product in order to gain the higher sale generally. So that is also one type of risk the business face. So when the company launch a new product in order to gain the higher sales in the market, that the business risk the company is going to face, the company is going to bear. And whatever the company taking the risks to fulfill two objectives, one is the maximization of the shareholders' value and the maximization of the company's profit. Other than the business risks, the other type of risks are there, non-business risks, which are not under the control of the funds. Generally, they arise out of the political and economic imbalance that takes place in a particular country. So the financial risk is also there. What we understand by the financial risks? Financial risks are the risks that the funds face with respect to the financial loss and which arises due to the instability and losses in the financial market caused by the movements in the stock price, the movement of the currencies, or fall in the interest rate or increase in the interest rate and many more. So, financial risks results in the financial loss to the fund. So, when the fund or the business organizations face the financial loss that arises due to the financial risks, the financial loss may be faced by the business organizations and funds due to the losses in the instability and the losses happened in the financial market. The market may be, the financial market may be the stock market, maybe the primary market, maybe the derivatives market, or maybe the international financial market or foreign exchange market. If something happened either in the foreign exchange market or in the stock market or in the primary market or in the currency market, that affects the company's financial position and sometimes it leads to the financial loss also. So that type of, when some risk is from the financial market, Some risk is from the stock market, or interest rate is increasing or decreasing, stock price, the volatility of the stock price, that will lead to the financial risk, which is to be faced by the business firm of the organization. So after knowing the some of the different types of risks, one of the investment risks which is coming out of the business risks, which is faced by the investor. The investors may be the individual person, may be the business organization. So when the business face some risks, either by investing, that means investment risks, or the business face any risks with the financial loss, maybe the financial risks. So that time it affect the asset value. It exposed to the decreasing the value of assets. And some of the risks can be internal and can be external. The business face the risks with investment, with the financial, some of them are the external and some of them are the internal. Which are the internal risks that can be controlled, but the external risks cannot be controlled, cannot be managed. So those which can be controlled are known as the systematic risks. Those which are external in nature and cannot be controlled are known as the unsystematic risks. So under the systematic risks that affect the entire economy and the overall market, or a large percentage of the total market, the systematic risks. Systematic risks, the business face. The business face different risks, like one of the systematic risks and on the unsystematic risks. Systematic risks, which is otherwise known as the market risks, can affect an entire economic market and a large percentage of the total market. So that time, the risks of losing investment happens. The chance is there we can lose out the investment amount. For that, many factors are responsible. Here, the factors which causes the risks of losing the investment, otherwise known as the systematic risks, are many more factors are there, like the political factors, macroeconomic factors, and liquidity factors, country-wise risks, socio-political factors, interest rate factors, inflationary factors. So all these are the risks which are, or factors which affect the systematic risks. And the systematic risks takes place due to the presence of all these factors, including the political factors, macroeconomic factors, interest rate, inflation rate, currency volatility, liquidity, country risks, and socio-political risks. These are the external, and due to these factors, systematic risks can take place for the company, and the company can suffer their loss, can suffer from the financial loss due to the presence of the systematic risks. So again, the portion of the return variability induced by the factors impacting all enterprises is referred as the systematic risk. Again, I am saying systematic risk means when due to presence of factors, there is a variability in the return, amount of return, the portion of return, that is known as the systematic risk. And the systematic risks, the diversification will not be able to mitigate such risks. Even if we'll go for diversification of our investment amount, then also we cannot able to mitigate, we cannot able to avoid the systematic risks. So then some of the reasons are there which leads to the systematic risks, like due to the change of the interest policy by the government. If the government changing the interest rate policy, that will affect the profitability position of the company. If the government changes the interest rate policy, when the banks, the RBI changing the CRR, SLR, accordingly the interest rates changed, then automatically that will be act as a risk for the company, for the investors. When the corporate tax rate increased, when the government changes the interest rate policy, when the corporate tax rate increased, when the government resorts to massive deficit financing, when the government is not able to fulfill its obligation, that's why government is going for the massive deficit financing. That is also will be act as a risk factor for the company. When the restrictive credit credit policy is there, so that the individual investors, they cannot avail the credit due to the strong credit base. So when the government fails to attract the FIIs, foreign institutional investors, are not coming frequently to any of the country, then that is also some type of risk. When foreign institutional investors coming to the to a particular country on a continuous basis, that there will be a high chance of inflow of cash to a particular country. So that will helpful for the investment, that will helpful for generating the revenues of a particular country, and the business they will face accordingly. The person of return variability, which is which takes place due to the presence of systematic risks, then that cannot be at all mitigated even through the diversification. So the change in the government rate policy, corporate tax rate increase or increment in the corporate tax, then due to the government is facing the massive deficit financing, all these are the inflation rate is increasing, the presence of the restrictive credit policy, then the failure of the government to attract the foreign institutional investors. These are the factors which affect the systematic risks as well as the profitability position and the performance of the company. So after knowing the systematic risks, then the second other category of the risks is the non-systematic risks. What we understand by the non-systematic risks? Unsystematic risks, otherwise known as the unique risks, can be completely mitigated through the diversification. Diversification means when we are investing at the same time in different assets, that is known as the diversification of investment. And unsystematic risk is the result of factors that are specific to the firm and not to the market as a whole. The systematic risks are the factors are not specific to the firm but to the market as a whole. That will hamper the total economic condition of the country. But here the unsystematic risks are specific to the firm, they are internal in nature and not to the market as a whole. They cannot adversely impact the market as a whole. Then what are the things, what are the factors, and what are the steps that leads to the unsystematic risks? Unsystematic risks, the factors are company specific, firm specific. It may be strike by the workers. If the workers are going for strike, then that will hamper the profitability position. The sales will hamper, the production will hamper. Automatically, the profitability of that particular company will hamper. Then if the research and development experts leaves a company, who are the research and development persons attached with the company who are contributing for the development of the company, if commonly they will leave, they will give the resignation, automatically that will act as a factor of risk, that will act as a risk to the company, which will hamper the profitability position also. Then other factors are, if some regulatory changes is there, either the regulatory changes has been done by the SEBI or by the Reserve Bank of India or by the other regulatory bodies like IRDA, like the banking sector, like in the mutual fund, some regulatory changes are there. And if a company is coming under that industry, then automatically that will impact the profitability and it will act as some sort of risk. Then if the company, for a particular company, another formidable competitor enters in the market who has the potential to acquire the market, it is also one type of risk. When a formidable competitor enters in the same line in the market who have the potential to capture the market, it is also one type of risk. Loss of big contracts in the company is not able to get a particular contract, the contract is lost, then that is also some type of risk. If the government increases the custom duty, if there is an inadequate supply of raw materials, it will hamper the production as well as the sale. So that is also some sort of risk. So whatever points I discussed, like strike by workers, research and development officers leaves, regulatory changes is there, formidable competitors enters who have the potential to acquire the market, loss of big contract, all these are company specific, fan specific, but it is one are coming under risks which will affect, which will hamper the profitability position of the company. So after knowing the systematic risks and non-systematic risks, I am going to talk about the degree of risk and a risk predictor. When we are going to calculate expected return from the any instrument, like the any instrument, maybe the equity share or debenture or bond, and how it is to be calculated, what is the degree of risk and a risk-free return. So the one formula is there through which we can calculate expected rate of return. Expected rate of return is equal to risk-free rate of return plus market risk premium multiplied by the beta, where risk-free return is the RF, beta value means risk of investing in the security is known as the beta, RM is the market rate of return, and market risk premium is equal to RM minus RF. RM means market rate of return, RF means risk-free rate of return. So if we have to calculate the expected rate of return, then we have to calculate risk-free rate of return plus beta whole multiplied by market rate of return minus risk-free return. So market rate of return minus risk-free return is equal to market risk premium. So when market risk premium multiplied by the beta and it will be added with the risk-free rate of return, then only we can able to calculate the expected rate of return. So what is return? Return means each and every investment expects some rate of return. So what is that return? Return means income received on an investment plus any change in the market price usually expressed as a percentage at the beginning market price of the investment. So when we are calculating the return, total return is equal to dividend yield or yield plus capital gain. Yield means what we understand yield. Yield means the most common form of return for investors is the periodic cash flow, otherwise known as the income on the investment, either interest from bonds or dividends from stocks. Yield is applicable with respect to bonds. When you are getting the interest from the bond, it will be termed as the yield. When you are getting the dividends from the stocks, it is known as the yield. When you are getting the dividend from the stocks, it is some sort of return from the stock we have invested. When you are getting the interest from the bond, it is known as the yield also. So return, total return is a combination of dividend yield plus capital gain. Dividend either in the form of interest from the bond or the dividend from the share market or stocks. Capital gain either appreciation or depreciation in the price of shares, in the price of asset is commonly known as the capital appreciation or capital gain. When there is loss, it is known as the capital loss. When there is profit, it is known as the capital profit. So when we are going to calculate the total return is a combination of yield plus price change, and that can be represented through a formula, and that formula is equal to total return TR is equal to DT plus PT minus PT minus 1 whole divided by P3 minus 1, where TR is the total return, DT means cash dividend at the end of the time period T, PT price of stock at the time of period T, PT minus 1 with the price of stock at the time period T minus 1. So that formula we can apply to a particular problem, and we can, through that problem, we can calculate the total return. So when we are going to apply that formula in a particular example, that example is the dividend paid at the end of year rupees 5. If the price at the end of the year is rupees 80, then calculate the total return of the stock. How to calculate total return? TR is equal to cash payment received in the form of dividend plus price change over the period divided by price of the investment at the beginning. So if you will put that in formula, then what we have received in the beginning in the form of dividend is 5 rupees plus the changes made during the at the investment during the starting of the year and the end of the year, that is 80 minus 70 is the price of the stock. So 5 plus 80 minus 70 whole total divided by the price at the beginning of the period, that is 70, is equal to 0.214. If that will be expressed in percentage, that means 21.4 percentage. If for a particular share, dividend paid at the end of the year is 5, price of the share is 80 rupees. When the share was purchased, it was 70 rupees. Then the total return can be calculated as 21%, 21.4%. For that, we can cite another example. If only purchase a stock of 6,000 and the end of the year the stock is worth rupees 7,500 and the dividend paid was 260, then the total return received by only by putting that formula, we can calculate the value is that 260 dividend plus changes in the price 7,500 minus 6,000 divided by 6,000, that is 29.33. So here the total rate of return is 29.33. So by applying this formula, we can able to calculate the total return and the total return as well as the expected return. So with that, I am going to conclude the today's class. So today we discussed about risk return, the risk return analysis, risk return trade-off, and the different investment functions and the different risks attached to the investment, as well as how to calculate the total return from the investment, either from the share or from the bonds. Thanks to all of you.